Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through a bunch of different ratios, see what's cheap, see what's expensive, see how things are changing. What this does is it's an asset versus another asset compared to history. And what we're looking for is we're looking for things that are cheap in relationship to history, and it gives us an area to start to focus on. Doesn't mean that just because something's cheap that it has to turn and get expensive quickly. It just gives us areas to say, yeah, this is really cheap compared to history, and these are the sectors that I should be looking at. And then we could potentially look at different individual companies or ETFs or whatever it is to say, look, this could be a good entry point for a long-term investment. And generally, what you'll see over time is you'll just see these two assets uh, or a group of assets that you are measuring against. They just go up and down against each other over time in a valuation channel. And what you want to find is you want to find an asset that's cheap against everything that will appreciate against everything for a period of time. It won't appreciate forever. It'll obviously peak out, probably maybe put in some sort of pattern, and then turn and go back down. And generally, generally how that moves is based off of the market conditions that the humans are subjected to. If you have a high inflationary environment, generally speaking, oil outperforms, maybe fertilizer outperforms. Platinum's generally done very well in high inflationary periods. And you can see uh, also if it's underperforming, it may mean that we're not in that cycle yet. So it gives us information about the market conditions. And if you know what market conditions are potentially coming, you can position in things that are undervalued that will appreciate against other assets if they do well in an inflationary environment versus a non-inflationary environment. So let's dive in. I'll interject my financial opinions as we go and look at a bunch of these different ratios. So I'm going to start with platinum. This is platinum to gold ratio. This is a topping pattern here. And we are at a very low ratio. zero point 0.4 is where we are today. And it's probably a good support level going right across here. I would say that platinum gold ratio, this is an excellent entry point for platinum. Excellent, excellent, excellent. This is like probably one of the cheapest times in history to buy platinum where gold is located. So platinum is incredibly cheap to gold. It also means that I don't think the commodity bull market has necessarily started yet. I think we're still before that, and I think this move in 2020 to 2021 was a precursor. What I think a big move is coming later. So that stimulus money came into the system. I don't think, I mean, it started the commodity bull market. It probably bottomed it out, but I don't think we've actually started the big super cycle, big move. Generally, what you need is you need an imbalance between oil and the credit expansion. So we got that big credit impulse move, but um, it's really calmed down since 2021. And I think it will reflare at some point. And I think this is a great opportunity to be looking for in terms of the valuation. Platinum to silver or platinum to palladium is next. We went all the way up to a ratio of 1 to 1 almost. We're at 0.9 right now. And that is still incredibly cheap where we are today. I mean, where the red line is down here. It's basically at the beginning of last bull market, and we peaked out up here. I think that's going to occur again. I think we're going to go up and peak out at some point up here where platinum outperforms palladium. So that's my take on it. It's cheap for platinum. Platinum to silver. Platinum is cheap to silver, and I know a lot of people say silver is the most undervalued commodity or undervalued investment in the world. I would disagree. I would say that platinum is cheaper than silver, at least on a historical relationship We are very cheap. It's 39.6, and it looks good for platinum to potentially outperform. One could argue that if oil gets cheap, since it's the number one commodity in the world, and if we actually do run into problems with oil, I would argue that oil is the cheapest commodity in the world because it has the most utility and value of any commodity. So silver's up there, yes. It's probably the top few in terms of valuations, but I would put platinum as a cheaper valuation than silver. And I would also say that potentially natural gas and oil are the cheapest commodities for how much value and utility they bring to human to humans. Gold to silver ratio, we're back at 90, which is really good for silver. That is very cheap for silver at 90. And I like silver too. And I do think that this will eventually work its way lower. So silver looks fantastic. This is palladium to silver. Whenever you get these large spikes, generally that's when you want to buy as much silver as possible. That is, I tried to swap my palladium into silver here, but the premiums went ballistic in 2020. So I decided to swap it into platinum. And we can see the outperformance of silver coming on down versus palladium. That's been a lot of palladium pulling back in the inflationary environment. And generally speaking, I've got the buy palladium down here. If it gets into this range, it's a good spot to be loading up on palladium if it eventually gets down there for that ratio. Dow Jones Industrial Average versus gold. Are we going to get a break to the upside where we get a one final blow off move for the Dow Jones? That could occur. That could occur. Maybe we get a monster move in the Dow Jones for a period of time. Maybe they print a bunch of money, blow it all the way up, and then we peak and come back down because this lead in pattern here looks very similar to this pattern here. These two lead ins there. And maybe that does occur. It doesn't. Maybe we break to the downside eventually. Now, I'm in the camp that thinks with time that gold's going to outperform Dow Jones and all these other assets at some point. Um, so we'll see which way this thing breaks. Gold versus Dow Jones flipped. Uh, again, I think that this is a double bottom where gold could outperform the Dow Jones when you look at it from this perspective. You dive in, and we're trying to break out eventually. But there could be a possibility that we do a slingshot where it comes like that and then slingshots higher. That is a possibility. Gold versus crude oil. We are cheap for crude oil. It is at 26.8. Generally speaking, 30 is a really good price to be looking to accumulate crude oil at a 1 to 30 ratio, which means 1 ounce gold 30, and that's where this white line is basically. You buy above the white line, you are going to make usually going to make a lot of money. Crude oil versus natural gas. Natural gas is at 47, uh, probably a double top, and will eventually draw downward with time. I think natural gas is probably the cheapest commodity. You can see where natural gas was a little bit more expensive in history from 1993 all the way till shale. Shale came online, and then that just blew natural gas to the upside in terms of how cheap it is. We've been living in a cheap era of energy, and we've been still running massive deficits. This gets more expensive, guys. Natural gas and or oil. It's going to expose those deficits and debts. Crude oil to gold. I like switching these things around. I think crude oil outperformed gold. We went into a bear market that ended here in 2020. We've broken out, done a retest here, and I think crude oil is going to go way up in relationship to gold for a period of time. But I like crude oil very, very much. This is a really good chart to give an explanation or a reason of why. Crude oil versus Dow Jones, just moving sideways there. It still looks good for crude oil to potentially outperform. You could also say that this is up to some degree, and then eventually we'll get a break. Dow Jones to crude oil, if I swap it around, looks very similar in the fractals. So if I were to take this fractal here, which is this guy here, and overlay it, and then blow it up, that's the fractal that I am seeing. So this top portion, this orange, this was the peak. See, the fractal's roughly the same, and I think it will draw down where crude oil will outperform Dow Jones, and it's going to come, my guess, down here eventually, and go to a very low level where crude oil outperforms. Dow Jones to natural gas. Natural gas is just ridiculously cheap, way, way, way up here. Blow off top, slingshot to the upside, which will slingshot to the other direction eventually. We've got gold versus TLT. It looks good for gold outperforming bonds, and that will probably continue higher, probably for the rest of our lives. Copper versus gold. We've been in a downtrend where gold has continually outperformed copper since the 80s, and it looks like that slight downward move is continuing. So I would look at gold. Uranium versus silver. Now, we've had a big outperformance here, and we've got a little bit of a red candlestick. Are we going to get a pullback? We'll see. It still looks good to go higher. Momentum still to the upside. Uranium versus crude oil. This looks like a potential reversal where crude oil could outperform uranium in the short term. There we are pulling on back. But again, we'll watch it. We'll continue to monitor it. Uranium versus copper. Looks like copper is trying to outperform uranium. Uranium's had a really big run, and it could still go up. I'm not stating that it can't. We do have a serious shortage in uranium, but right now it just looks like things want to pull back in uranium, and other assets could outperform. Uranium versus natural gas. My lord, look at this thing. We had a resistance level there, and it broke out of that resistance. To me, this looks like it wants to come back down. We're at a very cheap level for natural gas. Very, very cheap. Uranium versus Dow Jones, getting a bearish engulfing, which looks like we could pull back or go sideways for a while. Uranium versus platinum. We had a huge outperformance of uranium, and it does look like it's trying to turn back around. We'll see if that's successful. We'll continue to monitor it. There's a bearish engulfing, and we could pull back for a little bit. Uranium versus gold, it is pulling back for gold being in favor, and we do have dark cloud cover is what that's called, or a bearish piercing pattern. Uranium versus M2 money supply, we have another bearish piercing pattern which could pull back a little bit or go sideways. Then uranium versus the S&P 500, it is a bearish engulfing, which means we could pull back with S&P 500. And it doesn't mean that it will last forever. Just be patient, guys. We've got Baltic Dry Index versus gold. It is working its way up a little bit, but we're still at just a ridiculously cheap level. There's the topping pattern I saw earlier. That's the Batman guy. Double top, the double top. Good old Batman. Gold versus the consumer price index. Generally speaking, when this breaks to the upside, gold outperforms, and that's when maybe the gold miners can do very well if it does break to the upside. We've got natural gas. Now, natural gas is cheap against everything, guys. Absolutely huge opportunity, in my opinion, in natural gas because it's so cheap. Now, does that mean that it can't be cheap for 6 months or something like that? It could. It could be cheap for 6 months. We could get a buying opportunity for 6 months, but natural gas is cheap to platinum. Natural gas is cheap to gold. It is down at all-time lows. Natural gas to uranium. Could this be a slingshot where we slingshot higher? I think so. Natural gas to crude oil, it is incredibly cheap, cheaper than almost any time in history outside of this one little spot. Natural gas to copper, it is the red line going across. That is the cheapest it's ever been. Got natural gas against Dow Jones, which is also the cheapest it's ever been in history. We've got natural gas against palladium, which isn't the cheapest of all time, but it is very cheap. We've got natural gas against Baltic Dry Index, which is almost the cheapest time. It's real close. So natural gas is undoubtedly the cheapest commodity that is out there at this time. Not saying that it can't still get cheaper. Crude oil versus silver looks fantastic for crude oil to outperform silver. It looks like to me that we've broken out of this consolidation and we are squeezing up corner here where we can see a big move in crude oil outperformance. Crude oil versus the S&P 500, it does look like it's trying to bottom here, eventually work our way up. It looks much like a falling wedge to some degree. That's what I'm seeing. Crude oil versus gold, it also looks like a falling wedge where we could see outperformance of crude oil. Crude oil versus platinum, it's platinum's cheaper versus crude oil. Maybe platinum could outperform eventually. Crude oil versus palladium, crude oil's outperforming palladium. Looks like it could continue higher. Then crude oil versus uranium, which this looks like it's trying to bottom and turn back up, where crude oil could outperform uranium. That looks good there. And then I will run over to some of the ETFs. This is uranium versus XLE. It's a bearish engulfing. We could see potential move lower where XLE outperforms uranium. The ETF, uranium versus XOP, which is an oil fund, looks like we could see it go lower in the short term, where oil and gas could outperform uranium ETF. URNM versus the CRB index, we have a bearish engulfing, and this is mainly being driven by URNM, so we could see a pullback in URNM. URNM versus OIH, dark cloud cover, we could see a pullback where OIH outperforms URNM. Dark cloud cover in REMX, which means we could see an outperformance of REMX. And then URNM versus COPX, we could see an outperformance because URNM could pull back against copper ETF. Then URNM versus the S&P 500, could see a pullback of URNM versus the S&P 500 for a period. They are all bearish technical candlesticks where we could see a pullback. XOP versus REMX, it is up there and it is outperforming continually right now. And at some point, REMX looks like it's got to turn around, but not yet. XOP versus MU looks like we could higher. We've got XOP versus OIH, and I would say OIH be the one that I think outperform given where it's at. In the short term, it might still go up, but I think eventually it will turn and work its way lower, where energy service company, OIH, could outperform XOP. XOP versus GDX. Now, this is an important one. This was the buy of a lifetime down here, right in that corner. That's where I purchased. What a great opportunity. And this looks like it's ready to break to the upside. That also is confluence with the gold to oil ratio. Gold to oil ratio looks like oil could outperform, and then XOP looks like the positioning in XOP could outperform GDX. What does that mean? It means that we're probably going to get higher interest rates, I guess. XOP versus crude oil, we are outperforming since 2020, September of 2020. XOP versus COPX, it looks like XOP could break out of this against copper and really start to move if we can break to the upside. XOP could really outperform everything if crude gets moving here. OIH versus MU, I would say energy service companies, OIH, going to outperform the agribusiness MU. OIH versus REMX, I would say, the buy of a lifetime for OIH was down here. And we bought that on the website. We've been holding on, and I still think this is going to outperform. GDX versus gold, still getting some underperformance here, but this is almost the cheapest it's ever been on a ratio perspective for GDX. GDX versus REMX. So our GDX is outperforming. REMX has really been an underperformer, rare earth metals. GDX versus SILJ. SILJ is really cheap. I would be looking at SILJ and watching it. If this starts to turn, I could become a very big bull very quickly in this. I'm gonna just put this on the top here. What I kind of see here, and I'm gonna butcher this, but this is kind of what I see. It's a rising wedge. Eventually, this could break to the downside. GDX versus URNM, and we're at a very cheap spot for GDX. It does look like it's trying to put in a bottom, but that's mainly being driven by URNM selling pressure. GDX versus XOP. Again, this isn't a good location for GDX, but I think we've got more compression maybe possible for XOP outperformance. GDX versus COPX. GDX is cheap against copper ETF, and this is a good spot to look if it can reverse and start moving higher. GDX versus OIH is cheap for GDX, but still moving sideways. They're basically moving together. SILJ versus silver. SILJ is very cheap against silver. It's like a double bottom here. And we're just waiting for interest rates to drop, where I think this will go. But been holding steady and or drifting higher in interest rate. SILJ versus OIH. SILJ looks fantastic. We're right on support. SILJ versus XOP. We are very cheap and we're on support basically. It could get a little bit cheaper. SILJ could be one to watch. SILJ versus URNM. Very, very cheap. And it is ridiculously cheap against that. SILJ versus REMX. REMX is about, I would say, about average. SILJ versus copper, cheap for SILJ. And SILJ versus tan, cheap for SILJ. SILJ is really cheap. Copper versus OIH, I'd say it's favorable for OIH, which is the energy service company. Copper versus GDX, definitely GDX is cheap. And then I'm not going to go to tan. Baltic Dry Index versus gold. Baltic Dry Index is cheap, very cheap. Baltic Dry Index versus crude oil. Baltic Dry Index is cheap against crude oil. Baltic Dry Index against copper. It's cheap for Baltic Dry Index. Baltic Dry Index versus silver. Baltic Dry Index is cheap and outperforming. Baltic Dry Index versus iron ore, and Baltic Dry Index is starting to outperform iron ore. And then Baltic Dry Index versus uranium, it is cheap for Baltic Dry Index. So going through all these, we went through a lot of information, a lot of different ratios. What are some of the things that I can basically sum up? This is what I'll sum up. Platinum is cheap against everything. One sector I would watch. Natural gas is cheap against everything. Sector I would watch. Baltic Dry Index is cheap. Sector I would watch. And it's interesting to see crude oil because I think crude oil could be a big driver to the upside. We are seeing short-term weakness in uranium and anything related to uranium. Not like anyone hasn't noticed that owns uranium. I don't think it's ready yet to be a buyer in uranium. I know a lot of people are asking. I also think SILJ looks really cheap. Silver junior miners or silver miners, but been cheap for a long time. When are they going to turn and become more expensive? When are they going to outperform? I think that's going to deal with interest rates. We're going to have to see. I think what we're going to see is a decline in interest rate. Does that mean that the short end is going to drop or the long end will drop and they're going to move up? I don't know. I do think that silver looks pretty good, and I think that there could be potential investment opportunity there. And on the website, we are in a lot of these sectors that are cheap. We are hanging out in them. Some of them are doing incredibly well. And we purchased those some months back at the bottom, or not at the bottom of the bottom, but towards the bottoming of a pattern. And they have all broken out. we're riding that and reaping the rewards from being patient in those sectors. So again, those are the sectors that I think look really good. If you want, or if you're looking for individual companies and how to play all these sectors, sign up to the website, LEAP, because it's leap year. That's the discount coupon code if you like. And I share all of individual companies that I'm personally invested in, what I'm doing, and what I think looks good. And some of these, we've got really good investments in these sectors like the Baltic Dry Index, like platinum group metal miners, all that stuff. So that's what I've got for today. Give me a thumb up for the content, subscribe to the channel, subscribe to the website, and we'll catch you guys later. This is Finding Value.